Well, happy Monday. Looking forward to another Tech Talk this week. It's June 16th. Let's go over what happened last week and recap the Friday market letter. Anything else you want to talk about?
Okay, well, last week actually started out pretty well. We were on track for a third consecutive week of gains before Friday's sell off. But what we saw, a lot of investors were coming in and buying the early dips in the week on Monday and Tuesday. Several times we were down 300 points or so, ended up flat to higher. Part of that was better than expected inflation data, which led to a little bit of a slide in yields and also perceived progress in the US China trade negotiations. That also helped prop up prices during the week. We were actually taking a stab at new highs for the S&P 500 and the QQQ and the NYSE by the end of Thursday. We didn't quite make it because of Friday. As the week ended, of course, we saw the crude oil prices surge sharply higher. The energy sector jumped 5.62% on the week because of the higher crude prices. The other sectors were mainly kind of flat to mixed. Financial, industrial, and communication services were the weakest market groups. Healthcare also outperformed. So just a little bit of a shift towards a more defensive position. We also saw the Dow Jones lose support at the 200-day moving average, which is something that we've been talking about recently. It took a while to get back above that, and now we slipped back below. Today, as we speak, with today's market action, we have seen the Dow Jones climb back above that 200-day moving average. This week, we have a kind of a busy week with economic data. Tomorrow, we have the June FOMC meeting begins, and they'll make an announcement on Wednesday afternoon at 2 o'clock what they're going to do on rates. There's a 99.9% probability that they do nothing, which is what the market is expecting right now. Again, it's going to kind of depend on what Chairman Powell has to say about progress on inflation. Like I said, we did get some better than expected data during the week in the CPI and the PPI, where I think they both were up about 0.1%, which was below what we're looking for. And that's kind of in the Fed's wheelhouse, that they want to keep it flat. We're not seeing any deflationary things yet, but we'll see what Chairman Powell has to say. I'm sure he'll be a little bit leery about doing anything with oil prices spiking up. That was one of the things that we saw keeping inflation down, was as crude oil prices went from the high 70s down into the low 60s. That was deflationary there, and that was helping the inflation reads. We'll see how that goes. But like I say, today we did see crude oil prices pull back a little bit with what was going on over the weekend. The technical condition of the market remained bullish despite Friday's sell-off. It did pull some of the indicators back down into a neutral position, as you would expect. We were just below new highs for several indexes. Now, the MACD, which is a short-term trend gauge, has been kind of going flat for the last week or so. Momentum is measured by the 14-day RSI, pulled back into neutral ground and showed some slowing in the ascent. But that's not a big deal to me because, as you've seen, we have this V-shaped recovery off of the April lows. You just can't go straight up forever. Now, we talked about the last couple of weeks, we were kind of in a trading range with several of the different indexes going sideways. And that was good. That was a nice little bit of a pause. And I thought that with the CTI and the cycles being bullish, we can probably make a run to new highs, which I'll talk about that in just a second. The only index last week that was positive was the Philadelphia Semiconductor Index. It's up 50% or 45% run off of the April lows, and we're up again another 3% today. Part of that is with the whole market bouncing back, but also we had a couple upgrades. AMD, Advanced Micro Devices, upgraded by Piper Sandler, raised price target to 140. It's up almost 10% today as we speak, which is keeping the SOX up about another 3%. It's closing in on its all-time high, also from back in, I think, February with the SOX. So that's strong. We also see NVIDIA making another run. It was up 3%, I think, as we went into this. So that would be beneficial. A lot of times you'd like to see the secondary indexes, which include the Russell 2000, maybe the transports, but we don't weigh the transports as heavily anymore as we used to. If they can lead the market higher or lower, that's something that you like to see. Other things we saw last week in the technicals, we did see the VIX spike on Friday. It didn't go up to 25 or 30 or something like that, but it did get up in the low 20s. I think it was 20.82 or something like that. And that just meant that there was some worry that we could see more further downside as we opened up this week, but we didn't get that. Investor sentiment is still neutral. As we get closer to new highs, a lot of these professionals and retail, you're going to see them come back into the market. They don't want to miss this thing breaking to new highs. So that's something you want to watch. Retail bulls are still below the historical average. And at the end of last week, they were lower for an 18th time over the last 19 weeks. The pros are a little bit more bullish. They're kind of staying at around 82% or so, 83% exposure to equities. That's considered pretty normal. It's kind of a neutral position. We don't consider that a contrarian indicator until it gets up over 100. They start loading up on margin. We did see a jump in margin for May that was reported last week. It was a pretty hefty jump. It's not as high as it was back in January and February at the market top. But again, when margin levels start inching up, it's something you want to take note of, because that can be a red flag when everybody's getting that, if we do have a pullback, then people start getting margin calls and you might see more downside to the market than normally you would get a pullback. So what we have right now, it's kind of difficult to predict what the market's going to do. So I don't think this is something that you want to drop everything and jump back in and say, okay, it's over. You just want to be cautious and see what's going on. Now, I did want to say this. I do think another FOMO thing that we're going to see is we've been talking about, we kind of expected the market to be making new highs. Now, on this page here, if I go back over to the market at a glance here on the home page, if we scroll down here, you're going to see the NYSE advanced decline line. And, again, you can see this thing bunching up to new highs, and that's considered a leading indicator of market direction. Of course, obviously, you see that little pullback on Friday. Today, let me see. Today, the underlying breadth is pretty strong. The new highs are on the NASDAQ are 140 to new lows are 98 as we speak. So that's bullish. You're seeing the advanced decline line almost 3-to-1 to the advancing side. And that's something that is still telling us that we have positive divergence happening underneath the indexes, which probably will get us to a new high. Yeah, Friday we had more new lows than the new highs, but there's like maybe 20 stocks difference. So that wasn't much of a deal. And again, like I mentioned, NYSE advanced decline line made 2 or 3 new highs going into Friday. So I think we're still going to see, you have this momentum in the market. And when you get to these, sometimes it could be like the 30,000 mark or the 20,000 or 40,000 mark. It's kind of like when you're in a race and you're getting close to the finish line, you're going to have enough momentum. You're going to get there. And I think that's where this market is trading right now. You're going to see this thing break out to new highs. But I think that we could be getting close to a point where if you start seeing the retail and some of these guys jumping in, they want to participate in the new highs, our cycles will be starting to turn over here very shortly, in about 2 or 3 weeks. I think that as we break out to a new high, I think that's going to be it for the summer. Just from what I'm watching here, we see a lot of the cycles turn over, and we'll have to see how that goes. The market posture will turn either neutral or bearish by the time we roll into July. We'll have to see how that works out. In other words, the cycles aren't projecting us to have a rally throughout the summer. August historically is kind of a bad month, August, September. So I think if we can over the next week or two, we see the conflict in the Mideast drift sideways or start to run out of gas a little bit. A lot of markets will make new highs. You're seeing that in Europe already. We'll see that, but I don't think you want to chase that breakout to new highs. I think at that time, you may want to start thinking about getting a little bit more defensive in the market. But for right now, what we're seeing in the technicals and the underlying breadth and all, unless we get another real surprise in the Middle East conflict, we should be able to break out the new highs.
All right. So what should people expect looking ahead?
Again, when things like this happen, people maybe have a tendency to shoot first and aim later. I think if you sold on Friday, you're regretting it today. Best to take a cooler head and wait a couple of days. Historically, if you look at data, when you have market reactions to a war or something like that, generally the market will bounce back pretty fast. When it's going to have a deeper correction, it'll take a while for it to keep working its way down. So at this point, I would be cautious. Just kind of stay on the sidelines, hold what you have. Hopefully we can be celebrating some new highs here in the market over the next week or two.
All right. Very good. Well, thank you very much. I think that was good for today. And if there's anything else you want to add?
I think we're good.